Welcome, everyone. It's Angelo Robles, and today, the final melt-up before an historic crash. We have the return of one of our most popular guests. I haven't seen him in about 9 months, and lots around the world has changed in the last 9, really actually 10 months, so it's been a long time. I very much look forward to today's long-form interview with the one and only David, who probably now is upwards of 55 years of experience as a macro strategist on Wall Street and really around the world. This is going to be engaging, a lot of fun, and we'll start, before my first question, with a welcome, David. I hope you're doing well.
Yeah, hi, Angelo. Great to see you. Let me just correct you. I'm not that old yet. I'm only 52 years into my career, so you were close, but I don't want to age myself too fast.
I mean, I got 3 years up on you there. I'm making it the double nickel 55. I will have you back in that 3-year sense when we can definitely state that.
Let's hope so.
Again, yeah, of course, God willing for both of us. So here we are in the summer of 2025. You do talk about a historic melt-up. And a lot of people, after DeepSeek and Nvidia went down in January, Trump tariffs, the market's coming crashing down, and not quite. So here we are, generally having a good year in the equity market. So you do talk about a melt-up, but melt-ups often have one ending, and that kind of is a bust. How are you adapting your timeline for the continuing of a melt-up, and when do you think that bust could come?
Yeah, I am definitely still in the melt-up camp. I think we've been in a melt-up, depending on how broad you want to look at the chart. If you broaden it out to 3 or 4 or 5 year chart, you can see that we've gone pretty steep for quite some time. So really, you've been in a melt-up for since the bottom in October of 22. But at the very least, we've been in a melt-up since the April lows of this year. And, we've come back so strong, so fast, so steep. And I expect us to steepen from here into a top. So I'm called for what I call a 43-year secular bull market top to occur either late this quarter or sometime in the fourth quarter. People accuse me of pushing out the timelines, moving the goalposts, but I'm calling a market cycle. I'm not worried about the exact month it ends, and then what follows that will be an 80% bear market, in my opinion.
Wow,
that will probably take anywhere from 8 to 10 or 11 months. So most of 2026. And a global bust, actually a global deflationary bust. So while we're still seeing an awful lot of people, including Jerome Powell and the Fed, worrying about inflation, I think what's not very far away is our first deflationary downturn since the Great Depression.
Well, man, you give me a lot to chew on there. First of all, I'm not sure how much longer Jerome Powell is going to be in his current position, but we may get to that part a little bit later. What is maybe wrong with me and I'm no kid, I'm 60 years old, but I look at things long-term and I'm okay with volatility. When you know that we could have a truly significant bear market and a downturn in the markets, for some reason, I'm not really fazed. If anything, I look at that as an opportunity, depending on my timeline, my generational issues with my family, and my belief in our system, broadly the culture and mindset and American ingenuity and might is going to continue. And that's a grave question mark, by the way, all things we'll get to soon. Am I necessarily wrong to think that, Angelo, you might be right? If you're looking at 5 and 10 year time horizons, this could be a good time.
Yeah, it's tricky this time around. We've really been in this secular bull market since 1982. And as I like to say, since the mid-'80s, the financial industry kind of looked at the landscape and realized we've got this rat going through the snake. called the baby boom generation. And, they were instrumental in many changes in this country and many trends in this country because they were such a large population, and so you had the 60s generation, the turmoil in the 60s and early 70s. And then you had the home buying and accumulating of assets and furniture. And then in the mid 80s, the financial industry realized that these guys have bought their homes. They're in kind of the middle part of their careers, and they're starting to think about retirement plans and retirement. We want to service that. How best to service it? Since we're gonna need a lot more bodies here. It's no longer going to be the turn 'em and burn 'em stockbroker. We need to professionalize this more. So they came up with the mantra of it's time in the market, not timing the market. And so that's really why I came around to this from your question is for the last 40 years, you really could say as long as you stay put, the market's always going to go on to new highs. You're always going to be okay. As long as you're a long-term investor, just keep your money in there and it'll grow. The problem is we're coming to the end of a 43-year secular bull market and this huge bear market to follow, at least in my opinion. And I think the highs of this cycle will not be anywhere near matched in the next cycle. So these highs are likely what we see at the top of this cycle will likely not be seen again for at least a decade, probably two or more. So that means you can't just say, I'm going to just stay put in an S&P index, or I'm going to stay put in my portfolio because I know in the long term things will work out. And also the other piece of this is every cycle comes with new leadership. So it's going to be important to understand that what got you here, and particularly at this stage, because this is the end of a major secular bull market, the next cycle is going to be totally different leadership. So if you're in indexes, number one, you're going to be penalized because I think indexes are going to have a hard time keeping up with other things next cycle. If you're in growth stocks, the next cycle is going to be a very different cycle where it won't favor growth stocks. It'll favor commodity stocks and industrial stocks. So yes, in the long run, there are going to be great opportunities, and you're coming out of the bust, there will be great opportunities. I just want to make sure people are clear that you can't just buy through this and be okay on the other side.
Yeah. Excellent, Davey, to give me about 10 follow-up questions from that. I'm also thinking of the deflationary forces of AI, the impact of declining populations, how robotics may be impactful to that, but that may be 10 years down the road. But why don't I stay a little bit focused, not always easy for me to do, on the, again, more than 4-decade, like you said, secular bull market. There's some factors that play into that. Interest rates and print, meaning money. The money machine keeps on going. And now we have a $37 trillion debt. We seem like we always are in deficit by trillions of dollars. All things we'll dive into a little bit deeper. But I'm assuming in your macro analysis, all those things play into why you believe we're at the stage we're at now in America, in the West, and really around the world. And when it comes to the investing markets, let's just be honest, look at the math, look at the numbers. The US markets basically drive everything. So you believe that finally this train is coming to an end, but maybe I would like to hear a little bit more as to why.
Sure. So really, this is 80 years in the making. It's certainly 43 years in the making from the 1982 lows, but really what we've done is from the Great Depression, coming out of that and coming out of World War II, we've had these cycles where each successive cycle pretty much has created these imbalances and excesses, oftentimes inflation and overheating, that then require a Fed to lean against the winds and tighten down the hatches and bring the economy in so you can kind of work out those excesses and then be clear to rebuild another cycle. We've done that cycle to cycle all through that 80 years, and each successive cycle, again, pretty much We've had bigger excesses that required more aggressive tightening and more aggressive leaning against the winds. And then coming out of that, you were in a deeper hole and came again. So what we've done is kind of built up these excesses cycle to cycle where it takes more to crank them down. So then we got 2008-9, which was the biggest financial crisis in our history. And we printed an awful lot of money to get out of that. We continued doing that and following a zero interest rate policy for more than a decade. And that's created even bigger excesses. So the biggest excesses of our history occurred in 2008-9. And now we're here at this point in time staring at far more debt than then, far more debt than we thought that was off the rails, far more leverage now, far more derivatives now. So you have 330 trillion in global debt. You have quadrillions in notional value of derivatives.
Yes.
I call debt leverage on the system, leverage on the economy, and derivatives leverage on the markets, whether they be fixed income markets or equity markets, what have you. So leverage, we know from business school, is great on the way up. It leverages your returns on the way up if you do it right, but it's really damaging to you on the way down. It could be deadly on the way down because you've got all that debt and leverage that's working against you, and it can put a lot of people out of business, into bankruptcy, et cetera, a lot of companies. So that's where we sit, is this, we're at excesses we've never been at before, by far, beyond anything we've ever had. And you combine that with, because of the last cycle and all the zero interest rate policy, all the printing, you've got a Federal Reserve led by Jerome Powell that believes, and has stated many times, that was a mistake. The Fed got criticized for it, et cetera. And he's taken that to heart and said, we promise you, we're not going back to the zero interest rate policy. We're not here to backstop the markets. We're here to kind of keep the economy moving along. And when we see excesses leaning against them, particularly inflation. So they are of a mindset, and it's collective mindset throughout the Fed, that you want to be very careful not to go back to the policies of the last decade. And, we don't want long runs where you print too much money and you create all these other problems. So that means when things start coming apart because of all this leverage in the system, the Federal Reserve is going to be very slow to act. They're going to be very cautious they'll put money in, but they're not going to put in the kind of money that probably needs to be put in, because they're still looking at the last war. They're fighting the last war, looking at the last cycle and saying, we learned our lesson. We're not doing that again. And then let's say they start putting some money in, maybe $1 trillion in, and they find, given that the whole globe is imploding, that's not nearly enough, and things keep imploding. So they say, I hate to do this, but we got to do a couple more trillion. They do that. The point is, it's going to take them a long time, because of their mindset, to get to a right-sized policy. As a result, you're going to have all that time, because of the leverage, things will happen. The unwind will happen fast because of the leverage. During all that time that you're getting that unwind, they're having, they're walking into the policy. They're not getting anywhere near what needs to be done. And again, I'm using the Fed as the example, but this is really true across the board. All the central banks learned the wrong lesson of the last cycle. It's a correct lesson, but unfortunately, the only tool they have to meet a global bust head on and do something about it in a timely fashion is money. So if you are cautious about using your money, meaning the monetary expansion, you're going to just allow something to get a lot bigger than it needed to get.
Well, David, let me take maybe a little different perspective just to elicit your thought. And this may be what you feel could be a U.S. advantage, but maybe a decade or more down the road. You're correct, the $37 trillion deficit backed by quote unquote nothing. We also have corporate debt and personal debt. When you factor in the U.S. only, I believe those rough numbers are that 170 trillion. But what other country could say this? Not just our natural resources, including commodities like oil and the fact that we're self-sufficient there, but you look at the value of our companies, the value of our resources, it probably is a multiple of that. And I don't know if any other country could say that. Where am I missing the point, or where might I be correct, but that may take 10 years to play out?
Yeah, the problem is that when the cycle unwinds, all that stuff becomes moot. It's nice to have that there, but it doesn't do anything. You can't pull the resources out of the ground to meet the unwind fast enough. It's just like somebody in a home that has a bankruptcy. They may say, well, I've got things tied up that, fixed assets tied up that if I could liquidate them, I could pay my mortgage, or I could, hold off the bankruptcy. Unfortunately, the bank says, no, sorry, we're collecting now, and you don't have any way to stop that. So yes, we may have assets in the ground. We may have advantages in some ways, but this bust is all about an economic cycle that is highly leveraged and going to unwind very fast. I have to say, some of these other things that people are throwing out in terms of stablecoin and some things that they can do, I just don't think they're going to be nearly enough to offset what is coming at you in terms of both magnitude and speed.
Interesting. And what some people may be thinking is China, Japan, and others may not buy as much U.S. Treasuries moving forward. Would stablecoins be a way, I'm not going to quite say to keep the Ponzi going, but a little bit, built upon the rails of Ethereum? Are they basically going to be buying trillions of dollars of U.S. Treasuries? That will be interesting how it plays out. Like you said, it's worthy to note in our brain, but still may not be enough to really move the needle relative to the things that you're talking about. Back to your deflationary forces, when you say that to me, I'm thinking of AI. When technology can eliminate jobs faster than the economy can create them, doesn't that almost guarantee demand destruction that you've been kind of predicting? Does that play into your thesis?
Yeah, it may a little bit, but I don't think this cycle so much. I think AI is still in its infancy, and so I don't think it's going to impact. It's not really the deflationary force I worry about for this cycle. I think that force is strictly macro. It's basically all that leverage on the system and policy errors, along with, I put this in there too, because I don't think people pay much attention to it anymore. There's a lot more fragility in the system because of the pandemic. So we're going into a down cycle here because of the crazy stuff that happened since 2020. At least in this country, small businesses are a lot more vulnerable. We got a whole different job market than we had before. Certainly in the last 4 years, we had an invasion in this country in terms of the open borders. So there's a lot of things there that are below the surface that I think will kind of bubble up. But the biggest things are, a monetary mistake, a Fed policy mistake, a central bank policy mistake around the world, combined with this massive leverage. And I just think that's where you get deflation. We're at 2% inflation now, probably. The numbers that we use, the numbers the Fed uses, are probably biased upward because they don't account for the slide in housing that we're seeing. They don't account for a few things. So I'd say we're somewhere between 2 and 2.5% inflation. And we're about to enter a recession. Normally we enter recessions because we have, high inflation, maybe double-digit inflation. So we're down closer to zero inflation than we normally are going into a recession. And so that's why I'm pretty sure we're going to get into deflation in this, particularly if we're going to have the biggest economic downturn and financial crisis of the last 80 years.
And someone from the audience is asking, we're going to delay the question a little bit, but I'll tease it out a little bit. Are the things that David talking about going to be fueling the rise of mayoral candidates like Mamdani in New York. There's a new version of him now in Minneapolis and Minnesota. Not really a surprise, especially there. But it's a great question. It's on my list. It's going to flow a little better as we get a little deeper, but it's going to relate to that with some of the chaos that we're seeing now. Could I make the argument, David, of what I would loosely define as a wealth confiscation reality? Not just taxation, not that I totally understand that, but there's an element that is relatively pretty straightforward. But the fact of when you print money, the impact that has on inflationary resources, really everything. And half the country does not own stocks. They don't own assets that historically have appreciated in value. They're not participating in the system. Now, that could lead a little bit to some of the issues of the rise of some of the characters that I mentioned about a minute ago. When they feel that there's not a unifying, almost morality, a code, we're here for the greatness of America and willing to tighten our belt to show discipline. If there's $7.5 trillion of debt being added to the system, that's what, 57,000 per person. So could I argue this is for the government and arguably for the elites, but for 90% of people, this is going to be even more devastating. Now, that's going to lead to political upheaval and change, which will probably play its way into my next question. But why don't we start with the government monetary policy and the impact of inflation and how it confiscates resources quietly and secretly from really most of the population that doesn't own assets that are going up drastically.
Yeah, that's not where I come from. Basically, I think this is, as I said before, 80 years in the making. I view it as basically inevitability. They don't have a choice. That, like I said, the policymakers don't want to print money. That is the change here. They don't, Powell is sincere when he says, I don't want to do that. The central bankers that are on the committee really are all pretty much have bought into that idea that was a mistake. So I don't believe this is some kind of conspiracy against the little guy. It's basically the only tool they have to deal with something. At this point, if you ask the central bankers or you ask the government policymakers about a global bust and describe what I meant by a global bust, they'd say that's a very remote possibility. They are not expecting this. That's the point, is they'll fight. They'll tell you very sincerely that they don't plan to go back to ZIRP policy. They don't plan to go back to printing money, pushing out a lot of QE. And they're very sincere about that. That's nice to say until you're facing it, and you're looking at banks failing across the globe, big banks. And you're sitting there and you go, oh my God, what do we do? They can't sit back and say, well, in the long run, if we do this, it's inflationary and we know we shouldn't do this. They're going to be scrambling to do whatever they can, just like 2020. Look at 2020. I'm saying 2020 times 4 in terms of money, 20 trillion. So it isn't is no kind of planned thing. It's not them saying, hey, we can inflate our way out of this, and we don't have to worry about this debt because we'll just inflate our way out, even though it hurts the little guy. It's none of that. This is coming as an inevitability as a result of 80 years of bad policy, at least a lot of bad policy. And so I don't really see it that way. What I do agree with is that ultimately, with probably a couple of year lag, you're going to jumpstart an inflation cycle that will exceed the early 80s, meaning you could see 25% inflation in this country early next decade. And it'll be disastrous for most people, but certainly the little guy. And if we don't obviously go from 0 to 25 in a couple of years, it'll go, coming out of negative inflation, you'll be in low single digits the first year, higher single digits second year, double digits the third year. And I'm just guessing, and then higher double digits and ultimately above 20% within 5 or 6 years. I don't think most people have any idea. I'm not. You and I lived through the early '80s.
Mhm.
I don't think most people have any idea how really hard to deal with that is.
Indeed. And out of a courtesy to the audience, a couple of questions came in. They're a little bit off the sequence that I'm on, but I do appreciate audience interaction. So here you go, David. One of the questions is if Powell gets fired, more applicably, would need to step down. But let's go with that word. If Powell gets fired, with the dollar fall long term, rates rise, and stock markets, would they hit the circuit breakers?
Yeah. So first of all, let me just start with I don't know if Trump came out today and said he's not firing him. I suspect his Treasury Secretary spoke with him, and I think he has a lot of trust in Scott Bessent, and I think Scott convinced him that it would be counterproductive if you do this. You're going to create more turmoil and make it harder to execute your policies. So obviously Trump is very frustrated with Powell, and he's used to getting his way, so he's trying in every which way to get Powell to step down or make it uncomfortable for him. And I get that. It does create some uncertainty in markets. It does create some turmoil that doesn't need to be there. And frankly, where I don't agree with Trump is you don't have to worry about Powell. The interest rates, I say this all the time on the X, interest rates are determined by the bond market, not by the Fed. The Fed follows. The rates will come down, and they are coming down, even though they're coming down slowly. We were 5% over a year ago. We were 460 not very long ago, and we're 445 now. Have been down below that. So if this is a major top, if you look back, you're basically in a 2 or 3 year interest rate top here that I think has been in kind of a wide trading range. And I think once we roll out of that top, you're heading for 3% and ultimately 2% and in the bust down to 0% on the 10-year. So I'm not worried about the Fed. Trump shouldn't be worried about the Fed. The bond market will take care of that. What we found out last fall is the Fed can cut rates and the bond rates can go up, and they did. So I think Trump isn't an economist or a bond market investor, expert. So I don't think he understands. It's not the Fed controlling rates. And Powell's, yes, you can be frustrated. He should be. I believe he should be easing by now. That they're wrong to be worried so much about inflation, and they are looking at a lagging indicator in terms of jobs to determine when to ease. Jobs are the last thing I'd use because it's a lagging indicator. You're not going to get, there's a 6 to 9 months to when policy impacts the economy, right? There's a 6 to 9 months policy lag. Then you use a lagging indicator. That means you're going to be a year behind the curve. So, I think they're wrongheaded in doing that, but I don't think it's so much politics as it is not stupidity, just wrongheadedness. But to get back to what the impact is if he does fire him, you saw today a pretty muted impact when the rumor came out that he was about to fire him. Market sold off and bonds, interest rates bumped up, but not in any big way. I think that's because, number one, the people who would be replacing Powell, the 2 or 3 names that you hear the most out there, are respected people in economic circles. So Scott Bessent certainly, and the two Kevins, Kevin Warsh and Kevin Hassett, all 3 of those would be fine replacements. I don't want to see him do it. I really don't think it's, I think he thinks Powell's being very political. There may be some politics there. I certainly don't think there's any real love lost between those two, but I think he's mostly really fighting the last war. It's more because his whole committee is in the same place, as is most of Wall Street, by the way. Most of Wall Street is still saying don't cut. We don't need to cut. The economy's okay. I'm sitting there going, the economy's slowing down towards recession if we're not already in recession. The inflation is coming down, but it's, they still believe it's not down enough. So I think this is less about politics and more about just wrong-headedness. The dollar, did fall today on the rumor. I have a target of 82 on the dollar, and it's not based on Powell being fired. It's not based on any of that. So I'm expecting the dollar to go down whether he gets fired or not. And ultimately, as I said, rates are coming down no matter who's in that Fed chair. And ultimately means in the weeks and months ahead, not a year from now.
Yes, and of course, audience, I do understand with the dollar likely collapsing in the way that you describe it, the challenges to the markets. A lot of my investors or a lot of my viewers, listeners are investors. They're going to want to know to some degree where to hide. You might have hinted at it a little bit earlier, broadly with commodities, but we'll get to that shortly. I did promise at least another audience interaction question. How does the proliferation of rehypothecation and falsifying supply and demand resulted in the melt up?
Yeah, it's hard. Certainly the reaction to the pandemic and shutting down the economy in the second quarter of 2020, they were pretty much left with no choice but to do things, and they probably did more than they should have or needed to. But at the time, we had never had. They were in uncharted waters. We had the global economy pretty much shut down. If they hadn't reacted quickly, we could have had the bust much sooner. So kudos to them for moving, particularly Powell, for moving quickly. The problem is that, as I go back, I digress a little bit, but in 2008, we entered the downturn in 2008, fall of 2008, with $875 billion in terms of the size of the Fed's balance sheet. After the 2008-9 Great Recession and the reaction with all the QE, et cetera, we had a balance sheet of $3.7 trillion. So we went from 875, that had been the largest the balance sheet had ever been since 1913 when the Fed was created. And in 10 short years, we were up to 3.7 trillion. And then the pandemic hit and we added another 5 trillion. So we were up to basically $9 trillion. We've been, the Fed's been pulling money out for a couple of years. So that we're down to a little under 7 trillion, I think, in terms of Fed balance sheet. I'm saying we could see that up to 30 trillion in response to the bust. But the point is that we did have that 5 trillion. I want to put it in context. That 5 trillion that came in a very short period of time in 2020 and 21, that's still sloshing around the system, and that has contributed to the melt up, for sure. I mean, that is, I get picked on a lot on Twitter from extending my cycle, and I've stayed bullish all through this. So I think that's to my credit, not a detriment. But there are people who want to treat this like the price is right. You said this would happen by X, and you're still saying it's coming. So the point is that 5 trillion that went in, along with a lot of fiscal expansion, has extended the cycle. We're really in uncharted territory there too. So that it's coming to an end, but it's taken its time because there's been a lot more liquidity. So has it contributed to the melt up? Yes. Is there more to it than that? Yes, certainly AI is a new thing that's come in the last 2 years, and it is having an impact as well. I also think this is, which is why I called this 5 or 6 years ago. I saw this coming a long time ago, or at least thought I did, is that this is what happens when you get to the end of a very long secular bull market. It goes parabolic. It goes, that's why I used the term melt up. And by the way, I was And I'm not saying I invented the term, but nobody on Wall Street was using the term melt up when I started talking about it many years ago. And it's now in the lexicon pretty regularly. Some people misuse the term, at least relative to what I mean by a melt up, but we're having a melt up because we're late in a very big historic cycle. And that's what happens when you get late in it. There's for any number of reasons, including the money, but other reasons as well, we're going to go parabolic.
Aren't they, David, doing quantitative easing via the repo markets?
Not all that much. I mean, the repo market the repo window was pretty much drawn down. I haven't followed it too closely lately, but there's some money coming in through that way. But in terms of big money, trillions of dollars, no, we're not seeing the bigger problem. I think the bigger worry is that they are, even though we were at 9 trillion and we're still at, let's say, 7 trillion, and that's beyond anything we've been at in all of history except for the last couple of years, last few years. Even though that's true, you are taking it from 9 to 7. You have removed 2 trillion. So that's the other side of the coin. You have removed $2+ trillion from the system. And that does have impact as you keep doing it. You are moving towards illiquidity. So your view is a view that is shared by many on Wall Street that the Fed's too easy. I'm of the opinion the Fed is tightening. There's a stealth tightening going on that nobody's paying attention to.
And maybe turning our attention a little bit politically, I think it's pretty obvious when running for election, a politician's main job is not even a close number 2. It's to be elected 1, 2, and 3. When they're elected, it's to be reelected, if it's possible, or at minimal, to make their legacy and an impact and probably do well for them financially. We could argue that Trump, maybe with his meme coin a couple of days prior, already, quote unquote, did that going back to January. So politicians are going to say what's going to get them elected. People like Easy Street, people like free things. To me, that's socialism. And again, we're going to get to Mamdani and other things a little bit later. But back a little bit to the big picture of Trump, and I guess maybe a little clickbaity, some would feel. If you had to give him a grade, it's been, 7 months? And I know some of the trade wars and tariffs are going to take longer to play out. I understand that. And I would agree with you, Angelo, even if I don't give him the greatest grade, imagine what I would have gave if Kamala Harris won. So it's comparative to what the alternative would have been. That being said, and maybe if you want to keep the personal stuff out and just strictly on economic policy and the direction of the U.S., what grade would you give Trump?
I'm going to, there are going to be a lot of people who disagree with me, I'm sure, and particularly now with a lot of MAGA being upset as well. I'm going to give him very high marks. I don't know whether it's an A- or B+, whatever. Very high marks because of what he has accomplished against incredible odds. First of all, getting elected. He had everything against him. Everyone is, look at lawfare going on, everything. There is, I will continue to say, there is no politician in our time, and I'm a big admirer of Ronald Reagan for what he accomplished. There's no politician in our time that comes close to, and Trump's not truly a politician, but comes close to what Trump is. He has a backbone unlike any other person in Washington. They've done everything they could to destroy him, including trying to assassinate him, and he's come back. What I think people underestimate is how he, because he can be chaotic in some of what he does, like the Jerome Powell thing. But when you step back, you say, I don't know of any other person, including myself, who could remain calm, knowing that there's people trying to kill you every day. There's people openly saying they want to kill you. There's a hate everywhere. Trump derangement syndrome is a real thing. It's a real mental condition, in my opinion. And what did he do? I mean, nobody talks about this. or they talk about, but I don't think they really um, recognize the magnitude of it. You had between 10 and 20 trillion or 20 million people coming across the border. Last, in the election year, they tried to use, a phony bill to try to um, politicize it and say, hey, look, Trump's not on board with the bill. See, he's not really, he just wants this to be a political issue. And they were going to basically cap entries at 5,000 a day or something. It was an amazing number in that bill that was allowed, and he was right to oppose it, as were the Republicans that voted it down. And then what happens? And the argument used at that time was, if you have the laws on the books to control immigration, you don't need more laws. You don't need a new bill. And he proved that to be the case, because as soon as he got in, within a couple months of being elected, we have nobody coming in the country. I mean, no illegal immigration virtually. So again, I don't think people recognize how effective he can be when he decides something needs to be changed. I mean, you can talk about the social issues and things, but he's winning on those issues, whether you agree with them or not. He's been very effective in terms of things. He's taken over a Republican Party in Washington that always controlled the president coming in, right? They really, they were in charge. And he learned a lot from his first term, because Paul Ryan, among others, really stonewalled his efforts. He came in naively thinking, I'm going to come in, I'm Donald Trump, and I'll get things done. And he found out that Washington was this giant bureaucracy and swamp and deep state that was going to block him at every turn. And he didn't get things done that he thought he could get done. He learned a lot in the 4 years he was out. He came in this time much more prepared to fight that bureaucracy and to win. And he won on immigration. He won on the big, beautiful bill. Again, how many people argued that he wasn't going to get that through? It reminded me of Ronald Reagan, because I remember distinctly through the time when he brought tax rates down from 88% or whatever the marginal tax rate was, down into the 20s and 30s. And everybody said, because he ran on that, everybody said, that's a pipe dream. You'll never get that through Washington. That'll never happen. He did it. Well, this is the same thing. The big, beautiful bill. Oh, that's, there are too many people. You've got to walk a very fine line. That's impossible. He got it done, and he held the Republican coalition together on that. And he did it again. I don't think people appreciate how much he didn't horse trade a lot. He didn't have, he went in, and with the sheer power of his personality and his popularity, he basically went in there and said, look at the alternative. We need this. I understand what you want. We'll get some of that done through reconciliation, the Doge cuts, etc., to the people who are fighting, because it wasn't conservative enough. We weren't fiscally responsible enough. He didn't promise. He didn't go in and give away things to get this done. He basically just he went in and not horsewhipped them, but convinced them that we need to do this, and he got the bill through. Same thing, people, he's a peace lover. He does not understand killing people for the sake of territorial wars, etc. And so he was talking, obviously naively said he could stop the Ukraine-Russian battle in the first week of office or whatever. That obviously is, Putin's not cooperating, and that's a tough one. But people never thought he would do what he did in Iran, and he did it, and they executed it well. He's been on the right side of supporting Netanyahu and Israel in terms of Gaza, but also standing up to Netanyahu and saying, this thing's got to, you can't just keep pursuing this for very long, because you're killing people, So I think he's walking that line. Some may want him to be more isolationist, but he understands the need for the U.S. to be strong and to, in certain places, have to show their strength. But he's also not somebody looking to be expansionist, imperialistic. And I think that's a huge plus. So it's a long answer, but basically, when you go down the list of things, sure, there are things that I don't like his handling of the Fed. I think Mag is very unhappy with the whole Epstein thing because it looks like a cover up. I don't know what's going on behind the scenes there. There are things, but you're not going to get everything you want from a president, from any individual. I think when you put the whole package out there and look, I think he's accomplishing, and deregulation is another one. And again, he's 6 months into office, and this is what he's done. The most presidents in 4 years haven't accomplished 10% of what he's doing. Give him the next 3 years, and I think we're going to look and say, wow. Now, and I'm saying that knowing we're at, or at least feeling like we're heading into the biggest unwind in certainly the last 80 years, if not history.
Well, but David, that's going to be the challenge. If what you're saying is true in terms of the unwind and the markets crashing, perhaps late fourth quarter, possibly into first or early second quarter next year, that's not that far from the midterms. If he loses the public sentiment and loses the House and Senate and doesn't have the full authority to a degree that he has now, the back end of his final term is going to be more handcuffed than before. People are going to react to their pocketbook, to the markets. If what you say is going to be accurate, that's going to be a tough challenge looking out at the midterms.
Absolutely. He could be a lame duck president after 2 years. Right. I agree with that. I'm hopeful that's not the case. By the way, bust is, there's a bear market and there's a bust. The bust refers to the economy and the financial system. The bear market obviously refers to the market. I said the market might take 8 to 10 months, the bear market. The bust will be all the way through 26 and maybe into 27. So you'll be right smack dab on midterms in the heat of that. So I'm not underestimating that could happen. I'll take it as it comes. But Trump isn't causing the bust. This bust was coming no matter who was in, and if Kamala was in, Lord help us, it would have been worse. But
David, I am going to have to.
Trump is not causing the bust, but he's certainly going to be, the fallout, that he's going to have to suffer the fallout of it.
I mean, I am going to have to bring up a couple of things. One is how can we survive as a nation, any nation, when we effectively spend more money than we take in? We have about a $2 trillion fallout effectively in our deficit. And you look at it, a lot of it is defense, interest payments, and effectively entitlements. Okay, maybe you could shave $100 billion off defense because it's becoming more drone and a little bit more tactical and technical, and you could save some money there. You're not going to default on debt, so there's not much you could really do about that perspective with the interest rates, although that could evolve and bring that number down. And let's face it, we may need to be impactful to entitlements, but how are you going to win elections if those are things that you're talking about? Is there any way out of this mess?
Well, the first part of that is that the big, beautiful bill, I am, again, probably in a pretty small minority, but I am a huge supply side believer. And so what people don't understand is, and that's why, the so-called Freedom Caucus, or those that are, unhappy because we didn't cut more out of the budget. Yeah, what are you going to cut out of the budget? Like you say, entitlements are such a big part of it. Military, which needs to be rebuilt, is a big part of it. What's left in discretionary that you can impact, even though billions matters.
As Doge found out, it really may be a drop in a bucket.
Yeah, it's a drop in a bucket. So, So it's insincere or not very being very aware if you're thinking you're going to cut your way and you're going to raise taxes to solve a deficit, because you're not going to do that. It's counterproductive. Supply side economics basically says you provide the incentives through tax cuts, you grow the economy more, and you'll get more revenues. And that has been proven true many times. Our problem, and there are some in the Republican Party that do say this, our problem is not a revenue problem. We raise we've seen our revenues increase. Our problem is a spending problem. So, you don't need to raise more revenues through tax increases. And if you do increase taxes or marginal rates, you're going to get less. You cut taxes and you get more. So what Trump and Bessent and the economic team there are doing, and led by Art Laffer, frankly, they're saying we can get 3% plus growth by following the formula that we're using, which is deregulation, interest rate, ultimately interest rates coming down, drill baby drill, reshoring, bringing all this investment from overseas in here, and tariffs. We can actually shrink the deficit, and I believe that. What I say is, I don't think Trump's coming in soon enough to save us from the bust. I think the bust is already baked in the cake, probably. But if there's any hope that we're going to avoid the bust or that we're going to come out of it in good shape, it's his policies. And yet you've got a lot of Wall Street who are, they're caught in that static model that the CBO pushes. They all act like, if you do all the things he's doing that are pro-growth, you can't factor that into the model and understand that you're going to get more revenue from doing that. It's amazing to me. People want to call, and I certainly do call Powell brain dead sometimes, or wrong. I don't call him brain dead, but I do wonder about some of Wall Street. They should know better.
Yeah, I mean, you bring up several points, and this basically goes back to Trump and some of the economic policies. Yes, I get it. Markets like stability. When on Liberation Day, April 2nd, and he's talking about the trade imbalances, negotiation, and tariffs, of course we knew it was going to be chaotic. Obviously, the so-called experts ended up being effectively wrong, at least relatively in the short term. The markets reacted negatively, sure, for a couple of days, and then it's been a pretty great run the last couple of months. How could anyone who's an American look at the fact that we have wicked, unfair imbalances in our trade, and it's only fair to acknowledge that, bring that up, and negotiate? Now, China has a little bit of the edge in that they have the production refining capabilities of critical metals, things that are important to AI and to other aspects that we need. There had to be a little bit more acquiescence there. But I basically agree with you. I may not perfectly agree with you on the BBB. We'll get a little more to that in a second. But relative to being a tough negotiator, to changing the dynamic of what the deep state was for many years, and the areas relative to trade imbalances and tariffs could be positive for the U.S. longer term. It sounds like you're on the exact same page.
Yep, and I do think I use the phrase because when we had Liberation Day and the market fell out of bed, I probably had 100 or 150 responses a day where I was answering people who thought I was wrong, and they were taking the opportunity to tell me I missed this, and you said we'd have a 5% correction, we're down 20, and I was on there, and my favorite phrase for probably 2 weeks was "let it play out." Wall Street took his negotiation tactic at face value when he said he was going to have 80% tariffs, or he was going to do this, or he was going to do that. They instead of realizing he's just, it's the art of the deal, he's just negotiating and we got to let it play out, they reacted and sold their portfolios out and said, we're going down to 3,000, or we're going down to 2,000, or the bull market's all over. And I, at the bottom in the second week of April, when we were below 5,000, well, almost every strategist on the street was lowering their targets and turning bearish. I raised my targets right then. And I already was way above anybody else on the street. And I chose that time to raise them even more because I saw the sentiment had gotten wacky. I mean, it was just so extremely bearish. But yes, in terms of Trump, a lot of his approach is, he throws people off. He wants to keep people, I think, off balance. I think what people don't understand is he would not succeed if he couldn't follow through on what he starts at an extreme position. But if people saw that as just a bluff, and some do, they find out pretty quickly that if you don't play ball, it's not a bluff. I don't throw something out there I meaning Trump, that I won't stand behind, but I do hope that you'll come around. I start with an extreme and hope we can meet in the middle. But it wouldn't be effective what he does if he didn't, just like with Canada. I mean, he means it. If you want to commit suicide and follow your policies, we're bigger than you are, and you're going to suffer a lot more than we do. So I'll stick to this, but hopefully, cooler heads will prevail and we'll get a deal. Same thing with Europe. It's he means business but he starts from an extreme position and hopes that will get you to play ball.
Of course. And I guess I do have to bring up, you brought it up as well, the big, beautiful bill. We probably have somewhat of a varying different opinion from this perspective. I do have concerns relative to the U.S. debt that this is adding to it. I get it. Cutting entitlements, raising taxes is probably not going to be the answer, certainly not the answer to be elected or reelected. Really, then I guess it's going to be a challenging environment and then growth moving forward. If we get GDP growth, the impact of AI, all things we may get to a little bit later. But on the surface, it's frustrating to me that there are things in it that rather bluntly will take our debt guaranteed from 37 trillion to then over 40 trillion with really no end in sight. With the fiat currency, all currencies around the world that are backed by nothing, the full faith and credit of our government only, and all the challenges we're having here in the US, the West, and really everywhere, cultural, wars going on everywhere, the rise of AI, the impact of jobs. So Thomas Massey is not incorrect to bring up some of these things. I know some people are going to feel very differently about that, but it's still is frustrating to me that we may be on a path to bankruptcy. Where am I wrong in maybe embellishing this part of it too much?
You're not wrong at all. I mean, my instincts are with the Freedom Caucus, with Massey, with those in terms of, from an ideological standpoint, government, the swamp both sides in Washington have created this problem. We're way beyond anything we should be in terms of, down that road towards bankruptcy. And basically, as we see it, and again, one party's worse than the other, but they're both offenders. And when we see, though, the waste and the fact that they go in there, paupers, and they walk away multi-millionaires, if not billionaires, something's wrong with our system. They're robbing us blind. Doge, you can say what you want about Doge. They uncovered a lot in terms of the games that were played, particularly by, the left, in terms of the NGOs and the money funneling through the NGOs and back into their pockets. And I'm not saying Republicans don't have some of that, but the bulk of it was the Democrats. The problem is, when you're trying to solve a problem, you can't be ideological. And I think what Massey didn't understand is the alternative's 100 times worse. So in the end, we didn't need your vote, Tom Massey, but you were basically, either you were going to destroy the country because your vote was going to cause this not to go through, or your vote wasn't going to be the final determinant. We were going to get it through without you. So I don't think he accomplished anything other than, taking a principled stand. I agree with the principle, but I go back to what I said before. The deficit, again, all things being equal, and I'm calling for a bust, so all things aren't equal. But if we weren't staring at a bust or staring at a downturn, I would be making the case that the deficit could go away with the BBB. As I said, supply side economics, you deregulate, the banks are starting to recognize we're being unleashed again. After the Frank, Barney Frank bill or whoever it was we paired up with. But, when they tied the hands after 2008-9.
Oh, yeah. First Dodd-Frank.
Yeah, the Dodd-Frank bill. We're starting to unwind some of that. The deregulating of the financial system is going to allow some growth there, that not just in the banks, but what they promote, their lending, et cetera. So those are pro-growth bills. The opening up of Anwar, the opening up of drilling, and people don't realize how much this country is, as much as we are head and shoulders above any other economy in the world, we've had shackles on us with all this deregulation, climate change, et cetera. You take a lot of that away, and it doesn't mean all of a sudden we're going to be a polluting country, or we're going to be, doing things that are, not good for us or for health or anything else. In the end, a lot of regulation was silly bureaucracy and also a leftist agenda to hurt us. So when you take that away, you're going to be amazed at what it frees up in terms of the economy. The problem is I got that bus staring at me, so I can't know how much we're going to be able to head off. Number one, I don't think we're going to be able to head off the bus or head much off now. Where I think it will make a difference, though, is on the other side of the bus. And that's why the big, beautiful bill was so important. Getting that through means he does have his agenda still intact, even if he loses Congress. If he loses, in the midterm elections, he still has gotten enough through to deal with immigration, to deal with deregulation, to deal with, oil and gas drilling and expansion, to deal with reshoring. So, I don't think he necessarily needs Congress to keep his agenda going after that. And so I think where we're really going to see his agenda, his policies make a difference is on the other side of the bus. And it will be those pro-growth policies that I think you will actually see for a few years or a couple of years, deficit shrink. I don't know if they'll shrink all the way down, probably not, but it depends. He's bringing an awful lot of new investment into this country. So we could be surprised at the boom on the other side of the bus. The problem then is after the bust, within 2 or 3 years, because of the massive money print, and that money print will be accompanied by fiscal, so we'll even have bigger government spending because of the bust. You run into, probably by the end of this decade, maybe before, a problem of inflation skyrocketing, and inflation draws, interest rates follow inflation. So you're going to have double-digit interest rates and big government debt to finance. So you know this from our other discussions, I am calling for a global financial collapse in the mid-30s, because this isn't just the U.S., it's around the world. That the bust creates the opposite, which is we'll go from deflation to massive to hyperinflation, and still have potentially that 330 trillion in global debt will grow to 450 or 500 trillion by the end of this decade, and we'll be dealing with interest rates in double digits and ultimately high double digits. I don't think that equation can balance. I think ultimately you will see sovereign debt defaults, including the U.S. Because when you get inflation, and I'm jumping ahead on you, but when you get inflation of that level or anything close to double digits, the money printer gets shut down. The printing press gets shut down. You take the printing press away, and the equation is a closed equation that cannot be solved. if we won't have the money to service the debt.
Well, I mean, David, that's a very negative picture. If the dollar is no longer the world reserve currency, in that example, there needs to be something that could replace it. I don't see the BRICS being part of that yet, and I certainly hope not. That would not be good for the U.S. Not going to be the yen, not going to be the euro. Is it going to be some basket? How do you think that could play out? Now, that's looking 10 plus years in the future.
Yeah, you're right. The one thing I am pretty confident in is saying the dollar will remain reserve currency for the next 5 years, beyond 5, 6 years, whatever. Beyond that, it's anybody's guess. I don't know what comes of that, because don't forget, we're not in isolation in this problem. This is worldwide. China's not escaping this. Japan's not escaping this. Europe certainly is not escaping this, and I'm not sure the euro's going to survive the bust. So, I'm not sure. So I don't know whether there is going to be anything to replace the dollar. The problem is, I think that the environment I'm describing, the scenario I'm describing post-bust, where you have high inflation, high interest rates, and all around the world similar things, but the Fed and the central bank printing more than anybody else, because we are always the one that does the most. I do think the dollar could be below 50. I'm calling for 82. Then it could go up to 120 in the bust as people flee to the safety of the U.S. And then from 120, let's say in late 2026 or early 2027, I think it could fall all the way to 50 or below by early next decade. So I do think the dollar is going to be in trouble, but I don't know what replaces it.
I mean, David, what you're painting, and yes, we did talk about this the last time back September of 2024, and may have hinted at it the prior time I had you on, is kind of apocalyptic. Now, some of the work I do with family offices is planning, or at least considerations of disaster type scenarios. This is going down a road you probably don't often do in the incredible interviews that you do, but you just kind of leave that door a little bit open for me. Why would I want to live in a city environment, a New York City or other city, where there's a lot of people, a lot of grave challenges? We'll get to some of their political challenges shortly. They don't really produce anything. And if it's chaotic the way that you're describing, I mean, I could make the point that we're 9 meals away. That's 3 meals a day for 3 days, 9 meals away from the upper middle class going chaotic and things going bad. You're almost talking to me from the perspective of hoard your assets, move a little bit more rurally, maybe farmland, know how to produce your own stuff, believe in commodities and gold, maybe part of that digitalized, because that may be easier in terms of payments and moving it around, and possibly even have an optionality in more remote areas. If you have great wealth, I don't know, Iceland, New Zealand, various parts of the US. I never thought I would mention Canada, but maybe rural Northwest Canada. So again, I know this is maybe not the road you exactly want to go down, but am I correct to be concerned about cities and about you may want to hedge your bets, your risk, and really the only intrinsic value, gold is intrinsic value. Yeah, what's really intrinsic value is food and water.
Yeah, I'll start off with this caveat. Remember, this is a forecast, and although I've been pretty right for the last many years, and have seen things ahead of others for a while, I can be dead wrong. So I don't want people, going out and changing their whole life over something that might happen in the mid-30s. I do think there's great opportunity. What I give as advice to people after they hear my potential collapse scenario, what I tell people is, get your house in order between now and, let's say 2032. You're going to be given opportunities here. You could have, I just raised my targets for this year to 8,700 on the S&P, 30,000 on the NASDAQ, and 60,000 on the Dow, 3,400 on the Russell. Those are a long ways away. So they're still, in my opinion, some real money-making opportunities this year, even though we're not very far months away from the opposite, down the other side of the mountain. Then coming out of the bust, so first, you've got opportunities here. I don't want anybody to think they can call it to the end, but we're still not, people have, a lot of Wall Street has one foot out the door already and thinking that we're close to a rollover. We're not, at least not market-wise. Time-wise, close might be 3 or 4 months, but if we have 50% upside from here, 40 or 50% upside from here, that's not close. That's 3 years worth of returns. So first you have that opportunity. Then you have the opportunity of preserving capital by not following the buy and hold mantra or time in the market mantra and saying, well, most of the time that's a good philosophy, but right now we're heading for something big. I'm taking my chips off the table and I'm going to preserve my capital, whether it be in treasuries or FDIC insured savings accounts, or money markets will probably be backstopped. We don't know that yet, but the odds are the government will backstop them. Something short term that's reasonably safe. I'm going to take my money off the table, take money out of the market and preserve my capital. That's your second opportunity to kind of get your house in order. And then there'll be a point, whether I'm right that it's 80% down or 70% down, whatever it is, there's got to come a point where the market will bottom out. You'll have seen a lot of money come in and maybe some early signs that we're finding the bottom. And you don't have to call the bottom. You can wait and see some of the turn. But there'll be an opportunity on the other side of the bust, and a huge opportunity if you know that it's different leadership and it's going to be primarily industrial and commodity focused. So instead of going back into, consumer stocks or healthcare stocks or technology stocks or other growth stocks, you recognize that oil could go from $30 to $500 post bust. That means oil stocks could go up 10, 15, 20 fold. There's another money-making opportunity to get your house in order, as long as you don't say, well, I'm just going to buy the S&P because that's what I've always done and it worked. If you do that, you're going to be very disappointed because you're not going to get back to the highs of this cycle, and you may not get anywhere near it. But the point is, from now, 2025 to say 2031 or 2, 6 or 7 years, it's going to be not business as usual because we're going to be operating ultimately in an inflation environment, high inflation environment later in that period. But there's going to be still ability to own gold and silver and oil stocks and copper producers and, lots of things that are doing what NVIDIA is doing this cycle, or what Broadcom did this cycle.
Yeah.
And so, rather than focusing on 2035 or 2034 and say, oh my God, I can't sleep at night, I'm just frozen, I'm getting my money out, I don't want to touch the market because it could happen sooner. I'm just telling you, the next 5 or 6 or 7 years, focus on the opportunities that will be presented. But then, as we get to that point, is when things get a lot murkier. It's farther out, so I could be wrong, and it certainly could be wrong by many years, timing-wise. But I think there are going to be plenty of warning signs that we're not able to service our debt, that inflation's so high that there's no way we can print our way out of it. Those are the first warning signs that it's time to, what the popular thing of the last decade was, get off the grid, right? Go get away from the urban centers, because it's going to be, if I'm right, that we're going to see a global collapse. It's going to be survival of the fittest, dog eat dog. You're not going to be safe anywhere probably, but you're going to be safer if you stay away from the rats, right? Yeah. If you're in a place where you can raise your own food and your water's clean and drinkable, as you say, those are probably the biggest assets you can have. And then, from there, I don't know, guns, maybe you'll want to have them, things like that. But ultimately, I think that's a story for 2030 and beyond.
Yeah.
Um,
I'm only thinking, David, we may be 70 rock and roll guys, Warren Zevon, lawyers, guns, and money. I don't know about the lawyers part. I don't know how that made its way in there. But yes, it's interesting
and,
times.
and I just hope I'm wrong. I mean,
Of
as I
course.
say, I'm not so full of myself that I think I'm always right. I know when you start making these projections, and they're extreme ones in this case. And by the way, I'm not saying this to be provocative. I'm not saying this to get attention or get eyeballs or anything. It's what I see in my macro. As as I say, I don't know how you solve the equation of where we're at. Something that's built up for 80 years, and then you get the the bust, and it leads to the opposite, and you've created this huge debt problem. It leads to an equation that just seems impossible to solve.
Now, David, a little bit on the stock front. We, of course, have the Max 7 and quote unquote the other 493. The Max 7 is all dominant. Look at the great runs of NVIDIA. Look at what Meta's doing in AI and paying sports level packages to engineers. Google with its multiple Waymo and YouTube and business interest. Microsoft, a stalwart for 40 years. What do you think? You may think they may run like crazy the next couple of months, but a little bit more longer term, it's hard to imagine a world where a Microsoft, a Meta, strange how I didn't mention Apple, but they've been a little slow or a lot slow relative to AI, but they have massive amounts of cash. How do you think that could reposition the top 7 or 10 in the years to come?
Yeah, that's certainly not my expertise, so I won't talk very long on it. My guess is that there'll be winners and losers among that group, and there's probably going to be periods where AI doesn't live up to the billing, and certainly in the bust they'll struggle too. So I'm by the way, when I talk about a commodity cycle next cycle, doesn't mean there won't be winners in technology. I do think we will see, AI will play a role and maybe a big role, but it's just, I think inflation's going to trump it all. The massive money and leading to an inflation cycle and commodity cycle is going to trump all, but no pun intended there. I don't know. I mean, AI certainly is here to stay. It's certainly a productivity enhancer, but what we see always in these major things is the excitement initially, then leads to a shakeout, and some of the early winners don't make the right moves, or they aren't able to keep it up, and you get to a smaller group that are the winners, and then at least we saw with the internet, then it takes time for it to work through the whole system, and then you have the beneficiaries of AI become a story as well. So, I am not by any means an expert in that area or anybody with any great foresight there, but certainly it's gonna be an impactor.
As we take it a little bit in the final 20 to 25 minutes, I think there are an important direction that I want to take it. We hinted at it a little bit before, and I'm going to start a little bit en route to it. And that is a little bit of the housing affordability crisis. Mortgage payments now consume, 35% of median household income, while home prices are up, 56% this decade. In your bust, do prices crash hard? And does the market, or does it simply freeze due to unaffordability?
Yeah, I think certainly affordability is a huge issue, and that's not going to get better. Well, we'll get better because I do anticipate maybe a 30 to 40% drop in prices in the bust, and I might be low. It's hard to envision, but I'm starting to see it. I'm in New Hampshire. I'm starting to see it here. You're seeing price breaks. Things are staying on the market longer. There's more inventory coming out. I think people who wanted to stay on the sidelines thinking it was going to go up forever are now saying, "Oh, I think we've topped, and we better get our house out there for sale." So I think you're seeing, and you will see that around the country. I know Florida and Texas are getting hit pretty hard because of excess supply. Some of the growth areas where people flocked, it looked like that was a forever game, and it's not. So we're seeing a typical real estate rollover. I think it's just starting. I'm saying 30 to 40%, but that only takes you back to probably 2020 in many cases in terms of price. So we could go beyond that.
Right.
And then if you're printing, if the Fed prints $20 trillion, and again, that's a seat of the pants guesstimate of what it might take. But if they print anything close to that, that's going to lift a lot of boats. You're going to see housing get lifted because, and I've said this, I fully anticipate we're going to have a 0% 10-year rate in the depths of the bust. Okay. So when things are at their worst, the Fed is going to be buying every bond in sight to get QE up to 20 trillion, right? There's no worry about who's going to buy our bonds. We don't need China. We don't need Japan. We don't need anybody else because the Fed's going to be looking for every bond they can get to get 20 trillion out the door. Now, some of that is going to be because the Treasury is going to be increasing their bond issuance because fiscal is going to be also expanding pretty rapidly. But anyway, so if you're printing $20 trillion to get the economy jump-started again, to save the system, save the financial system, it won't immediately translate when let's say mortgage rates down to 2.5%. It's going to be 2.5% for those that really have pristine credit, right? At the bottom of the bust, banks are pretty stingy. They're being careful because they're in trouble. They only want the pristine credits then. And then coming out that first year in recovery, my experience is through many cycles that when housing goes down, it doesn't rebound right away. It's usually kind of a laggard in terms of the first year out because you've got overhang, you've got a lot of foreclosures, you've got inventory, you've got, consumers still digging out from the bust. So that first year out, you may have a great opportunity in terms of mortgages and availability of money. So it may stimulate some, but it's probably not going to be a runaway V recovery in housing. They might bounce, but if they're down, let's say they're down 40%, and maybe they come back 5 or 7 or 10% from that. And then the second year, maybe the economy's a little firmer ground. People have jobs. Interest rates are still reasonable. They may be up to 5% mortgages by then, but still pretty reasonable. You could get maybe your best bounce that second year. And then I think by the third year, you're looking at double-digit mortgage rates, and that's a huge headwind that's going to probably prevent real estate from moving up from there. So I think the peak this year or this last 2 years, because a peak in real estate probably happened a year ago or more, that peak probably doesn't get revisited anytime in the next cycle. So, you might, if you're down 40% in price, you might get back a third of that or a half of that. If you're, and your activity is probably going to be a lot less because if you've got an 80% bear market, people are going to lose a lot of money. Those that didn't get out, the wealth effect is going to be down substantially. And then if you have a 30 or 40% decline in home prices, that's the other piece of your big wealth that's down. And then let's say you lost your job, or your hours were cut back, what have you. So there's going to be a lot less people qualified to buy homes, I think. The government will probably be trying to come up with programs again and do things. And I'm sure during the bust, you're going to have all kinds of programs just like you did in the pandemic, universal income type programs. But it's very hard for me to make the case that this isn't the peak in housing for years to come.
Yes, very good points. And we're going to trend down that direction with a debt-driven anti-capitalist generation that is uprising, a young socialist perhaps winning New York and maybe Minneapolis. But to diverge just a second, because I think my audience would be very mad if I didn't ask, I'm going to name a couple of assets that are more commodity driven. And maybe because we have to keep it a little bit round robin, we'll go a little quick on it. One of them you already covered, but I think I do need to bring it up again if you wanted to put a bow on it in 1 minute, and that would be oil.
Yeah, I think oil. I've been the bear on oil through this last, certainly last 3 years, and before that, um, I missed the run. I was kind of cautious on oil back in 22 when Russia invaded Ukraine, and I missed the pop that happened in about 2 days to 130. But I got on the bear call there and said this. I'm not, oil's going down, not up. If you remember at that time, this was right in the middle of the invasion. With oil at 130, 120 to 130, you had a lot of calls for oil to 200, 150 to 200. And I was saying, no, it's going back to 85, or certainly back below 100. And then when it got below 100, I lowered my number to 60. Or the 60s. I didn't say 60s, 60s. And then I lowered it to 60 somewhere along the way. And I've been there ever since. So when it went to 55, I was the only one out there that was even close to looking for that. And I've said since it got to 55, it overshot my targets. I basically said it's in a trading range now, probably 55 to 70. And we'll go to 30 in the bust. So that's my view of oil pre-bust. And it bust. On the other side of the bust, I think oil is one of the huge opportunities. If you can get in anywhere near the bottom of the bust, I think you can make. I was there in the late 70s when oil represented at the peak in 1980, I think. Oil represented 35% of the S&P. What is it now? 4 or 5% less than that. So that's what will happen is at the top of the next cycle, not this cycle, the next cycle, it'll go from that 3 or 4 or 5% weighting to being 35% of the S&P again. So oil should be a big part of people's portfolios. And I say oil and gas. I don't forecast natural gas right now because number one, there's so much of it's weather related. Number two, there's so much surplus that it's hard to know, that it's low and it's not going to take off here. Once you get on the other side of the bust, ultimately, I think natural gas might go to 50. It could go to $1 in the bust. So if it goes from $1 to 50, it tells you what kind of move you're having. And the point is that you're going to, when you print $20 trillion and every central bank in the world prints proportionally similar, so there might be $100 trillion coming out. People's Bank of China will be doing it. Bank of Japan will be doing it. Bank of Canada, ECB, Bank of England. When $100 trillion coming out or whatever the number is, you're stimulating with a lag. You're stimulating demand. The demand that's going to be stimulated is going to be more industrial than consumer this time around because of all the movement around, trying to get out of China, trying to, bring assets home, bring capacity home. It means there's going to be huge demand for commodities, right? So what you do is you artificially prop up or rapidly build up demand because you printed all this money that goes into the system and creates demand for something, whatever it's going to be. In this case, I think commodities. We can't, and you have a finite limit of commodities because to build a new greenfield mine might take you 15 years or more. To go out and explore for oil and gas takes you time. It takes several years to develop a new oil field, et cetera. So we'll be boosting capacity in all the fields we can, all the places we can. But the point is that you're going to reach a point where demand for commodities far outstrips supply, and there's no quick relief of that supply because it takes a long time. We've spent 30 years downsizing our commodity supplies, right? Whether it be for climate change reasons, they limited where you could explore, whether it be because of just-in-time inventories and an economy that was more consumer-oriented. We didn't have, the companies, and they're trying to meet quarterly earnings. they all rationalize their capacity down. And then all of a sudden you get this instant boost in demand because of $20 trillion or $100 trillion around the world. And, the demand changes quickly. The supply doesn't change quickly. And the only thing to give is price, and price goes through the roof. That's from a bottoms up standpoint. That describes the inflation I described from a macro standpoint. In other words, I give you the monetary reason why you're going to see us go from a deflation to 25% inflation. But then you can see it from a bottoms up standpoint in that commodity scenario. And of course, it's not just commodities that go up in price. Goods are going to go up in price because of the rise in commodities. So and you get this inflationary spiral. Ultimately, wages will go up to help meet that inflation too, or help offset that inflation. So that's when you get into a true inflation spiral. Those that saw the inflation of the 2022 period have no idea. What I'm describing is much more like the late 70s and early 80s. And as I say, will probably be that on steroids.
Huh. We still probably have 4 to 5 questions. I know you're going to be a little crunched on time. Of course, and I'm going to lump them together to maybe save a little time. How about gold and silver?
Yeah, gold and silver, I like a lot. I think gold and silver in the next cycle probably will be the last guy standing. So, even oil will peel off somewhere along the way, but late in the cycle. Well, I think gold and silver probably go right to the end of the cycle, just like NVIDIA goes right to the end of this cycle. So gold and silver will be they will be competing with oil as the top performers, I think. Certainly the other base metals and things will do very well too. But I haven't forecasted gold for this cycle. I call it pre-bust, meaning it's probably by the end of this year, of 4,000. I had a forecast of 3,000, raised it to 3,400 sometime mid-year last year, I think, and then raised it to 4,000 when we were at 2,500. At 30, I think when we were at 3,400. I raised it to 3,400 when we were at 2,500. So I think 4,000 is a target pre-bust. Post-bust, I think gold can go to 20,000. And silver, I have a pre-bust target that I've had for quite a while of 75, again, end of this year type of thing. And my post-bust target, probably, by sometime 32 or 3, 31, 32, 33, 20, 31, 32, 33. I think silver can get to 500.
And David, I do have to ask, Bitcoin.
I do not follow Bitcoin. People keep trying to get me to follow it, and I go, as much as it's popular and doing very well, it's not a commentary on what the investment prospects are for it, but I don't consider it macro significant yet. It may be, but I want to see it get through the bust. I think crypto in general and Bitcoin specifically has not gone through a serious downturn, and this one's going to be the granddaddy of downturns to date. So let's see how it does in the bust. I realize I understand the story. I understand the supply demand. I understand that it's outside the system and that adds tremendous appeal. And I understand that certainly we have a president that's friendly towards crypto and friendly towards Bitcoin. So I get all that. I just don't follow it enough for anybody to care about my opinion.
Of course, David. In our final topic, I'll begin it with Voltaire, the iconic, of course, thinker. It's dangerous to be right when the government is wrong. And leading into that, without a unifying morality, effectively societies fall apart. Coupled with our debt, our challenges, and some of the things that you mentioned, I look at the rise of a debt-driven anti-capitalist generation, kind of Gen Z, having 94,000 in debt. and the challenges that they are facing. I look at big cities like New York and the rising cost of living there, of expenditures. There's grave challenges. Oh, this could never go wrong. Well, a little over 100 years ago, Argentina was one of the greatest countries on earth, and still beautiful and great people, but it's been in massive struggles for well over 100 years. Now, Javier Milei, interesting, we'll see, likely making some good choices, but what, it took that 120 years, and he may not even make it to the next election. We just don't know. So we have some grave challenges that are challenging what I said earlier about a unifying morality or societies fall apart. We see the rise of Mamdani, who likely, according to the poly markets, is going to be the winner of the mayoral election in New York. We see the rise of the gentleman in Minneapolis, who I heard today mention two things that to me were aghast, and that would be talking to the constituency, you deserve. I'm of a belief that I deserve shit. I deserve nothing. I have to earn it. And he spoke about free things, because I guess politicians always want to promise you free things. If we have a society that doesn't want to work on that unifying morality that ties us together, and societies fall apart, if we don't want to do the hard work, if we want things for free, if we want debt to be forgiven, and we want this and we want that, how could this end well? Does it start in New York and Minneapolis? Does it spread to effectively every big city? Do we lose a young and rising generation to the challenges of socialism and effectively really more communistic that just doesn't work and has never worked? And the fact that governments produce nothing, David. They rely on me and you to be entrepreneurs, to be income earners. They rely on the taxation, and they steal our money through inflation, I could argue. Henceforth, this is a very, very trying time. I don't know, is this a grand social experiment by certain powers that be? Is this something that's going to cause a fraction within the U.S. or various factions that evolve during some of the crisis that you're talking about? And what can we do to, I want to be careful how I phrase this, but to stop it, not with force, but with having people wake up to realities of you have to work hard, you have to acquire assets that are going to rise in value. You have to have a skill set and acquisitions of skills that are going to be employable in more challenging times to come. Maybe I'm wrong. Maybe I'm an old guy that thinks of when I grew up with cowboys and the Americana and apple pie, and maybe those days are gone, David. It'll be sad for both of us from a different era. What do you think about what I said? And how would you look at the things that you're seeing happening in New York City and really beginning to crumble around the West? We've seen the challenges that many countries in Europe have had.
Yeah, it's frightening that he won the primary and seemingly has a big edge so far, because the others are dividing them and going to divide the pie on the other side. So if you've got Cuomo and the other two dividing the pie, he obviously is going to be swept into office, and that's frightening. But I will say, we've had socialists in our government for a long time. He's very extreme, but we have, we've had Sanders and AOC and lots of them going back, and frankly, an awful lot of Democrat Party for many years now has been socialist, if not worse. And so that's not new. What's new is this new generation of voters who, unfortunately, again, this was by design, are products of a very what's the word? But an education system that has not done a good job of educating, and has purposely educated them in leftist ideology. And so they come in wanting everything given to them. They think that, there's a lot of the younger generation, not all, there's some good ones in there, but there's, a pretty large percentage that are even thinking that communism isn't so bad. I mean, in this country, that's hard to believe, but we're at that place where the younger generations have, the focus has been on wokeness, on diversity, on all these things, and rather than teaching them economics, and so I think that's a problem for us countrywide. It's certainly been a problem in the cities for a long time. I also blame, those in a place like New York who could stop this pretty quickly, and some have, by voting with their feet. I mean, it'd be, I think that experiment would end pretty quick, if a lot more of those on Wall Street and elsewhere, instead of buying apartments there and saying, well, it's the devil we know and we're going to stay here, said, until this thing improves, we're out of here, And we did see, obviously, an exodus once they, the last time around. So I do think it's a bad trend, and it's part of being at the end of a super cycle. It's unfortunately, it looks like it could be the decline and fall of the Roman Empire. We get fat and happy, and we forget what got us here. And there is some hope. You mentioned Malay, and you've got Maroni in Italy. You've got Trump, and you've got a few others around that are, the move back towards the right. And it's not a fascist right. It's a move back towards capitalism, towards freedom and free markets. There is some hope that movement is gaining ground in Europe and gaining ground places. I don't know whether it's just too late, And again, this probably should be said, that if we do get that total collapse in the mid-30s, all bets are off in terms of what comes out of that. Maybe. I know the Austrians want to believe you get a collapse and then you can start the whole thing over and do it the right way. The risk is that you come out of that with communism or something, and it's the end of, certainly in this country, the end of the great experiment. So, but yeah, I mean, I worry about all those things. I think we've had a decay in our moral fiber. We've lost a lot of religion in our society. I mean, the mainstream Protestant churches spend all their time pushing the woke ideology, and they've lost a lot of membership as a result of that. The Catholics are to some degree holding on, but they've lost their way in some ways. So it's Christianity, which was the Christian Judeo backing in this country, or the fiber of this country, has frayed, and it's still there. I mean, in times of crisis, you do see that they're still basic, but I'll tell you this: even though there are a lot of people frowning on formal religion, I think the fact that few of the younger generation are growing up in the church means anything goes. Their idea of what's morally right and wrong is somewhat clouded, and that goes hand in hand with the economic side of things, the socialistic things. So, and then adding on to all of that, and maybe it may even be the biggest part, and hopefully Trump's going to be able to put a stop to it, but or at least Trump's election is beginning the turn, is you had the globalists that were deliberately, I think, tearing this country down. The whole idea of pushing us towards a one world government, and taking away sovereignty and all of that. That movement's still out there. It's been pushed back a bit thanks to Trump and Morley and Milley and some others, but make no mistake about it, there are a lot of people in Washington that were part of that.
David, I don't think you and me will be getting any invites to the World Economic Forum anytime soon. David, I know you're a little crunched on time. I do want to do a 2 or 3 minute close, and if you have to step out while the audience hears it, that's fine. But before you do that, you're a wonderful follow on X. You're doing great work. How could some of my listeners that may not be as familiar with the great work that you do follow you and learn more?
Sure. I'm on X or Twitter, whatever you want to call it, every day. Usually in reply to questions and comments, not original tweets, but you can find me there at Dave H. Contrarian is my username or my handle. So at Dave H. Contrarian. And I put out an awful lot. Some days I'm on there 10 or 12 times, other times, 40 or 50 times, but depending on questions and comments. But a lot of my forecast, a lot of my views that you heard here, I'm on there, updating them and talking about them. I also write a quarterly letter, macro letter that if people, it is by subscription, if people have an interest in it, they can direct message me on X, and I'll be glad to send details. So it is, people send me a note and say, I want to sign up for your letter. Can you tell me how to find the link? And I go, it's a subscription letter. You have to pay. So just so people know, I think it's a reasonable cost for what I offer, but that's in the eyes of the beholder.
I agree, David. I'm a big fan of David. I highly recommend that my listeners, my followers, my members certainly interact and learn more. And I would encourage being a paying subscriber because I think it provides great value. Because David has a very significant audience and he's always kind enough to share our interviews with his audience, there's going to be newer people that are not as familiar with me. So a little bit in my close. First of all, I'm Angelo Robles. I've been in the family office community for many decades. I'm the original founder and longtime CEO of Family Office Association, which I sold. Kind of retired, active allocator investor, have family office structures and holding company in Wyoming. Maintain a pretty active media presence on LinkedIn, where I'm very active, and on YouTube with the greatest moniker ever that I registered many, many years ago in the family office world, simply at Family Office. So you can follow me there, kind of have a backup channel at Family Office TV, moderately active on X, probably not as active as I could be. And many people also would simply go to my website, angelorobles.com, where there's information a little bit like David, what I do on membership, which is proprietary intelligence and strategy for ultra high net worth investors and family offices, and the programs that I host around the world, and great guests that I get a chance to interview and hopefully introduce some members to with people like David. Yes, I cover areas and topics like I did today, including the final area of my conversation with David, that really honestly most people in the family office world don't touch. And even people in what David does, if he had an advisor and social media, they may even recommend, don't even touch Angelo's last question on Mondambi. But the reality is, I don't care to be politically correct. And I'm not saying I'm right. Like David, I'm probably wrong my fair share. But I want to have open and honest discussions. A little bit like playing poker. As the hand changes, I may adapt how I think. I'm maybe strong opinions, but relatively loosely held as conditions change. I don't mind tackling subjects that are sensitive by some in the family office world. So if you're enjoying what you're hearing in the conversation, certainly go to angelorobles.com. At minimal, follow me, like for David, on my free social medias. A little bit in my final minute. We had a great in-person event at an amazing penthouse in New York City yesterday, where some of the subjects that I spoke about with David, I led a discussion on, and again, not recorded, where we could really go all out about what's going on in New York and around the world, and some incredible investors were there. I will be in Newport, Rhode Island, Sunday through Tuesday. If some of you are going to be around there, you will probably see me. I have an incredibly active summer, including my AI Family Office Masterclass in person in New York, if they allow me in New York, August 11th and 12th. And although I'm going to be doing some solos between my next interview, like I did here with David, I did want to announce the next interview, which will also be longer form like I did with David, that I'm doing is probably someone that David is familiar with. And that would be Mark Faber, the legendary Swiss economist who lives in Asia and Thailand, well into his 80s. He's incredibly fluid and opinionated. And a little bit like my conversation with David, I'm sure there'll be some fireworks and some interesting conversations to have. What I remember about Mark, unless he changed, the last two interviews I did, that's the boom, doom, and gloom. For some of you may know him from that perspective. He enjoyed a nice beer with a cigarette because I think it was about midnight his time in Thailand. I guess he never sleeps. I may have to take out my cigar. So only for Mark Faber will I do that ending next week. But again, I want to thank David Hunter. Thank you all for being a part of this. I'm a huge fan of David. I enjoyed so much my interview with him and look forward to sharing it with my network over the coming days as well. David, thanks for being a great guest. I always appreciate you.
Yeah, thanks, Angela. Thanks for having me on.
Thank you. Always a pleasure. Thank you so much. Bye, everyone.